Okay, stocks, commodities, currencies, bonds. This is a big section. I published 3 articles last week. You should read these articles. They're meant to be educational. They're our own original research and opinions. They were posted. If you go to the website and see this presentation, I posted a comment on the front page of the website with these links. I also sent it out in an email. So maybe the next email I'll include it. I plan on writing more articles. These were published on talkmarkets.com, so which is a big aggregated financial website. So and they're all about. We're going to mention these: the Double Death Cross. Double Death Cross is a cross of the 50-day crossing, the 200-day, and then the 325-day. And we use the 325-day cross to confirm that the first cross was actually accurate, because that's failed to be useful in the last several years. It's a classical thing in technical analysis. It goes back to early 1900s, and it's ceased to be used. So we came up with a new way of making it useful. So you should read these articles. They're all meant to be educational, and if you're interested in technical analysis, or if you hate technical analysis, don't read them. Okay. Okay. Once again, here's my title: Dangerous Stock Crash in Late March, April ? David has it in May, and he says it might move forward. Now, my reasoning for this, first of all, this Double Death Cross, which we see as a warning sign that the market's in a bear market. This has happened on all 4 U.S. indices. One article explains why it has to be 4. It's the Dow, the S&P, the NASDAQ, and the Russell. It didn't happen on the NASDAQ last August and September. That's what kept the market from totally falling apart. Although, as David pointed out, the Russell has fallen apart. It's in a bear market. There's no question about that. And that's small caps, and it's a broader market. So, I mean, that's more important than, say, the Dow. Now, there's one little thing waiting, and that's for the 200-day in the NASDAQ to cross the 325-day. It's happened on the other 3 indices. This is like very, very close. It's about to take place. Once that happens, there's nothing holding the market up, and that should happen in early March. So you add a couple of weeks, you're in late March, and you say, well, okay, maybe there's a 6-week time frame, so you're in April, maybe even in early May. I mean, these can intersect, actually. So all you need is like if some black swan event. A black swan event is something that comes from left field or out of the sky that you're not anticipating. The market would like really crash. It would just, because nothing else would be holding it up. Yes.
You're saying the 50 has to be below both the 200 and the 325, or the 50 is below the 200 and the 200 is below the 325?
Yeah. Well,
which one is this?
Both. The 50 has to be below the 200 and 325, and the 200 has to be below the 325.
Got it.
That's the end. The Double Death Cross is the first part. The end bear market pattern is the 200 finally falls below the 325. Sometimes it actually only takes a day or 2. Sometimes we're going to see some charts, sometimes they're very close together. And then a couple of days later, after the Double Death Cross, you got the second part, like that. And like it almost happened on the FTSE in England, we'll see. So once that happens, let's say this is early March sometime, some terrorist incident happens in the world, an assassination of a political figure, a bankruptcy, a bank failure. I mean, the market is like, all the underpinnings have been cut out of it. So like any bad pressure that could push it down can push it way down. So we don't know any of these things are going to happen. They may not, they may. We'll have to see. And we do know there's a banking crisis in Europe. Deutsche Bank is in very big trouble. And Deutsche Bank's a mega bank like Citibank. So imagine Citibank going under. I mean, the whole financial system would collapse. Now, the Italian banks all together are in really bad shape. The French banks are mostly in really bad shape. So it's not just Deutsche Bank, this is like the whole European banking system. And we're completely integrated with this banking system. So if they go, we're going to go too. So, and the central bankers will do some massive rescue efforts. They've done this before, we'll see what they do. Now, the other thing lurking in the market that's causing weaknesses is a big drop in junk bonds. This happened before the 2008 crash, and this is happening right now again. And then there's NYSE short interest is actually at the highs it was in 2008. And that high actually took place just before Lehman went under, not after. People say, oh, it happened after. No, we have the chart. We'll show you. Okay, pay attention. So here's the short interest. You see that a first green line is actually where Lehman failed. Notice the short interest was at its peak before that happened, which is quite interesting. The second green line is the bottom of the market. So the short interest rose before the market collapsed and peaked before the market collapsed. And by the time the market hit bottom, a lot of people, the big money had gotten out and knew they stopped out their shorts and they left. So we're right around that point. We could go a little higher before the market fell apart in 2008. So this should raise both your eyebrows. Next. So high yield junk bonds, this started the collapse, or certainly warned about it in 2008. And you can see the bottom in 2008 and early 2009 on the left side of the chart. And then you see we're like falling. There was a drop in 2011. The economy fell apart. The markets almost collapsed at that time. The central banks started printing money. They did a lot more QE, and they pushed the market back up and saved it. This time we've now gone lower than that point already, and we're trying to head toward that bottom in 2008, 2009. And we could get there sometime this fall, ironically, not March, April. The March, April might be a temporary collapse. I mean, a collapse, but then we could go up and it won't be the bottom. It will be a precursor to a worse bottom in the fall. I don't know if you have that in your system.
Well, I think we can get down through to next year. So.
Oh, well, yes, we can keep going forever, yes. When the stocks went down in 2000 in the tech bubble collapse, they went down for 2.5 years in that time period before they bottomed. So once the market goes down, it can go down and down and down and down and down. It can be a multi-year event. And the low was incredibly low at that time. So we're looking at this. The junk bonds are in very bad shape. We look at that bottom thing with that's a DMI with those two arrows. That black line should never go above 40. It's already close to 50. And this is a monthly chart. This is a massively long chart. So any signal on it is like very potent. And the junk bonds have actually been, because the red line and that indicators above the blue line, that indicates a bearish pattern. Even though the price was not going down, there was actually weakness in this market for years at this point. So that is not a good sign. We also see something we haven't discussed yet, and we will more in the next few months. The blue line is the 20-month moving average, and the goal line here is the 10-month. Now, when the 10-month falls below the 20-month, that is actually a mega bear signal. It's not a bear signal, it's a mega bear, which means things are really going to drop. They're going to drop a lot. This is an extremely negative signal, and it was given in early 2015 for junk bonds. So these are the weakest part of the financial system. They're like tanking. And it easily could bring down the banking system or any number of other things, which is probably what's going on in Europe. Okay, commodities, currencies. Oil may not have bottomed. I agree with David. I have a low on the futures of 26.22. I think he has 26.05 or something. Doesn't matter. It's a couple of pennies. But I think a sharp rally is in store this spring. That could be any time in the next, say, 8 weeks or so. It could be April. It could be late March, April, even early May. And this could take oil to $50. It could even happen in a couple of weeks. And I think momentum is building for a production cut. The oil producers are suffering. They're suffering all over the world. The Saudis who started this are suffering. And, they will finally give in. Someone will give in and say, okay, we got to cut production. Even if they don't cut it that much, they may not. The market will react explosively because everybody is short. And I've mentioned many times in this meeting what happened in 1998, and I think it was April. Oil was $12.50. And I remember someone coming on CNBC News saying, and she was a commodity analyst, she, everybody is negative on oil. Within a week, oil was 40% higher. 40%. It had one of the most explosive rallies ever. When everyone is negative on something, they all shorted, they all sold. There is no one left to short, and that thing can only go up. And all of those shorts, once they see it going up, run for that door all at the same time. So you get these explosive rallies. Oil has set itself up for this. Maybe it's not going to happen this week, but any, like, say, production cut that's actually, like, agreed to, I mean, you're going to see all the shorts are going to all run for the door at once. Now, what happened after that, they all came back in the door, and oil actually went to $10 in August of that year. So it did go to a lower low, but it took like 3 months or so. And David's work seems to indicate that type of pattern could exist. There's a bottom in the summer, and we could get this sharp rally. So that's a tradable rally if it happens. You should watch very closely. I tweet about this every day. So a gold, I actually think, has bottomed, or we don't have enough proof to actually say that. This is just my opinion so far, my hypothesis. We need a double golden cross, which is the opposite of the double death cross. We need the 50-day to cross the 200 and then cross the 325-day from below. Silver will follow gold. No matter what you read or hear, it always does this. I don't care what, like, you know, there's too much supply, there's not enough supply, you know, blah, 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 blah. It will go wherever gold goes. Watch the U.S. dollar. The breakout, it tried to break out, it failed. It has not made that double death cross yet, so we can't say it's going to go down. It looks like it wants to go down. I'm actually quite negative on it. That drop would be positive for oil, gold, and any other commodities, and the Australian dollar, which is the Aussie, or the Aussie.